All right, so in this video, we're going to talk a little bit about some insurance basics. So first off, let's talk about avoidance versus minimization. And this is basically referring to the fact that the whole thing that's driving insurance is that we have various risks. So there are various things that could happen that could cause different types of financial losses. And so when we look at the different kinds of things that could occur that could cause financial losses, we have kind of a spectrum of things, and you can look at it sort of on two dimensions. One being the likelihood of the outcome, the other dimension being the magnitude of the loss. So if you think about the kinds of things that could occur, you could have things like the probability of a flat tire. Probably not real high of a probability, but it definitely can happen. The cost of the flat tire, not terribly destructive for your entire financial well-being for the most part. So probably that's something that we're not going to worry about buying insurance to cover my flat tire, probably. Now, there might be some exceptions to that if you're not feeling comfortable changing a tire. Maybe you do pay for roadside assistance or something like that. But it's possible that you evaluate, you think, not too much of a probability of having a flat tire. Maybe you know how to change a tire, and so you think, okay, not a big deal. You could also get to things that are low likelihood of happening, but they would be pretty catastrophic. For instance, the chance that your house burns down. The probability is statistically pretty low that your house is going to burn down. But if it does burn down, that's just catastrophic for your well-being financially, and just your well-being in general. So for something like that, most people would normally elect to, let's go ahead and buy some insurance for this. For something like the risk of a car accident or something like that, probability is not real high, but it can still be pretty damaging financially to you if you got into a car accident. For instance, if you caused a car accident, in many states you're considered to be responsible for the damages you caused, and therefore, if you hit and totaled out somebody's $50,000 car, well, that's bad for you financially. That's where insurance can play a role to help out with that, right? Now, if we think about those kinds of things, people sort of look at what's the probability of the event occurring, how bad would it be if it occurred, and when we put those together, certain combinations of those will lead people to think, we ought to get insurance for this, and something to help kind of protect me from this financial outcome. And that's kind of the idea behind insurance, trying to kind of protect from the risks that we have here and the financial damage that would occur. That brings us to avoidance versus minimization. So if I'm facing some kind of a risk, and let's look at, like the car accident example. If I'm looking at the car accident example, avoidance might mean I just don't drive as much. So I just don't drive. If I'm worried about causing a car accident and damaging somebody else, I can just avoid that risk by not driving. Well, in certain cities, that might be realistic, where maybe you could walk everywhere, take the subway or something like that, or buses. But in a lot of other places, that's just not really going to be all that feasible. So for certain kinds of risks, it might be possible to avoid, but maybe not entirely. Minimization in the car driving example might consist of, well, maybe I don't drive on certain roads that have a reputation for having lots of accidents, being particularly dangerous. Maybe I do a safe driving course so that I get better as a driver to kind of minimize the chances I cause an accident. Maybe I buy a vehicle that has some advanced features that help to warn me in my blind spots or things like that. And so those would be some ways we could possibly minimize some of those risks. Let me give you another example of avoidance versus minimization. So for let's say we're looking at skydiving. So if you think about skydiving, there is a non-zero probability of death, basically, with skydiving, right? So if you have a non-zero probability of death with skydiving, avoidance would mean we just don't skydive, right? So if you're worried about that, you just don't skydive. And we can avoid that. We just don't do that. Minimization would look a little bit different. Minimization might mean, well, I'm concerned about the risks of things going very badly and ending very badly, skydiving. But maybe I really don't want to give up skydiving, so I try to minimize it. Well, how can we minimize it? Well, we can do maybe lots more training. I can try to learn a whole lot more about how to do skydiving. We could have a backup parachute. So I have my main parachute and a backup parachute in case the main parachute malfunctions. I've got a backup there. I could I could do skydiving in tandem with an experienced instructor. So in that case, I'm attached to somebody who knows what he's doing, and so I minimize the risks there. And so there's some ways that I haven't completely eliminated the risks. I still have some risks, but I'm kind of minimizing them. Okay. Now, if you do have a situation in which you're thinking about buying insurance, let's look at sort of an example of how the basic idea of insurance works. So if we're looking at the basic idea, let's assume that we had 100 homes that were worth $100,000 each. And obviously that's probably low, but it makes the math nice and simple. So it'll work out better for us. So we got 100 homes worth $100,000 each. And let's assume we have no other risks other than fire. So fire is the only thing that's going to damage these homes. The only risk we have to worry about. And let's also assume that the risk of the house completely burning to the ground is 1%. There's no either or. In other words, it's not going to burn part way to the ground. It's either going to be completely fine or it's just going to be completely ash. Okay. So let's say there's a 1% chance that it's just going to burn to the ground this year, which is really high statistically. And let's, if you think about that, so there's a 1% chance that this house worth $100,000 is going to completely burn to the ground. Well, if that's the case, then what you can do is you can take that risk of the fire, the 1%, you can multiply it by the value of the house, $100,000, and say that on average, then we expect that a person who owns this home would, on average, out of every possible scenario that can play out, on average, would expect to lose $1,000. Okay, so in other words, 99% of the time, nothing happens to the house. 1% of the time, they lose $100,000. We average that out, and basically what we get is, on average, you're expecting to lose $1,000. Well, if that's the case, then what we could do is, if I have this problem and you have this problem and everybody else in my 100 people with $100,000 homes has this problem, well, what we can do is we can buy insurance. So we find an insurance company, and what we'll do is we will pay them more than the expected loss. So maybe I pay them, say, $1,500. Okay. So I pay $1,500 and everybody else pays $1,500 to the insurance company. And the insurance company basically then takes on the financial risks if the house burns down. Okay. So I pay more than the expected loss. But the benefit is if the house actually burns to the ground, it doesn't wipe me out financially. Okay. So I'm sort of placing a bet when I buy the insurance. I kind of think it's possible my house could burn down. That'd be really bad. I'm worried about it. So I'm paying to basically, in effect, transfer that financial outcome to somebody else. Now, the risk that the house burns down in this example is still 1%. Okay, so buying insurance doesn't mean that you have changed the risks of the outcomes. It just means that we have changed who bears the financial responsibility for the outcomes. So let's say I pay $1,500. And let's say everybody else pays $1,500. So overall, everybody pays $150,000. We got 100 homes, each person paying $1,500. So we're going to pay $150,000 to the insurance company. Now, if the statistics are correct and that the risk of fire is actually 1%, somebody's house is going to burn down this year, right? So if one house burns down, that's $100,000. The insurance company pays out $100,000 to rebuild it, and they're left with the extra $50,000 they got because everybody paid $1,500, and we had 100 people, so that's $150,000 that the insurance company received, and the insurance company then had to pay $100,000 to rebuild the house. The insurance company gets $50,000. Now, we individually paid more than the expected loss, and that's fine. I'm actually happy with that. The reason for that is I'm paying more than my expected loss, basically in order to transfer that risk of a bad financial outcome to somebody else, so I sleep well at night. That's the basic idea. So I'm willing to pay more than my expected loss because what it means is I don't have to worry about the loss. Okay. So I'm going to pay a bit more than the expected loss, but it means that if my house burns down, it doesn't destroy me financially. So I only, on average, expected to lose $1,000. I'm willing to pay more than that so that I don't have to worry about it. Okay, and so that's kind of my benefit if I'm the person buying the policy. I pay more than the expected loss, but then I don't have to worry about it if I happen to be the unlucky person whose house burns down. Now, for the insurance company, what they're looking at is they're trying to assess those risks of fire and make sure they're charging enough to each person to compensate for the homes that they have to rebuild, and also to compensate them for the risks if things kind of work out a little poorly. For example, what if 2 houses burn down this year? Well, if 2 houses burn down this year, everybody still has their insurance policy. The insurance company only collected $150,000 in payments from the people who bought the policies, but now they have to build 2 houses. So the insurance company's gonna have to pay out $200,000, and they only collected $150,000 this year. So they're in trouble. Yeah, that's gonna be a loss for the insurance company. So the insurance company is looking at the odds of how many houses are going to burn down and what the risks of those particular losses would be. And they're trying to make sure that they charge enough to compensate for the risks that they're taking on, but also to compensate the insurance company for taking on the risks that this could actually end kind of badly for them if more than the expected number of homes burn down. Okay. So basically, the extra money that I am paying as the buyer of the policy above what is expected compensates the insurance company for having the very real risk of things going kind of badly for them. Okay. And so I basically pay them some compensation so that they get compensated for the risks that they're taking on. I am willing to pay a little extra to compensate them for that risk because then I don't have to worry about it and I can sleep well every night. Okay. Now I'm hoping that my house obviously doesn't burn down and I never use the policy. Okay. But I'm willing to pay a little bit more than that expected loss so that I sleep well at night. And the insurance company is also really hoping my home doesn't burn down because if my home doesn't burn down, and if nobody's home burns down, they get to keep all the money, which would be fantastic for them. So the best case scenario for the insurance company is everybody pays their $1,500 every year for the insurance in this example, and nobody's house burns down and they walk away with the $150,000 and they'd be happy with that, right? But there's also the chance that 2, 3, 4, 5 houses burn down, some kind of a wildfire or something like that, and the insurance company doesn't have nearly enough money from all those premiums, the money that the people paid to pay for it. So hopefully this is kind of making sense as sort of an example. Now, I do need to emphasize that obviously not every house is worth the same amount. Obviously, we can have more risks than fire, so that complicates things a bit more. And obviously, the risk of fire in my example, 1% is wildly high statistically. But hopefully, this conveys the idea of kind of what's going on with insurance. So let's kind of recap sort of the key features here. We have sort of a possible but uncertain loss, right? So we might have a scenario where the house burns down. We don't know. Okay. So it's possible that it could occur. Also, you buy the policy in advance. If your house is already on fire, you can't buy the policy. And the reason for that is, well, if my house is already on fire, then the expected losses are, pretty much like the $100,000 I'm expecting to lose the house. So in that case, the insurance company's going to look at that and say, well, let's see, the probability of that house burning down is about 100% since it's actively on fire. And so the house costs $100,000. I'm going to charge you like $100,000 for your policy. Okay. So you can't buy the policy when it's happening. You're going to have to buy the policy in advance when there's just a chance that it happens. Okay. And ultimately, you kind of have to have enough people sort of willing to pay to kind of make the statistical odds kind of work out that you can kind of transfer that risk. And again, the insurance company is going to charge a little bit more than the expected loss to compensate them for the risks that they kind of goof up on what those losses are going to be, and they don't charge enough. And that basically, more houses burn down, and they have overhead for doing all this as well. And we as the people buying the policy, we're generally okay with that idea because what this buys me is a good night of sleep, so I don't have to worry about it destroying my financial situation. Okay, so we need to have possible but uncertain loss. Okay, so the house can't be on fire, right? So I got to buy the policy in advance, right? So it's a possible but uncertain loss. If I knew that my house was going to be on fire, now the only way to know your house is on fire is if it's going to be on fire is if you're doing something illegal, like setting your house on fire, right? But if it's possible that it could be on fire, but I don't know, and I have to buy it in advance, and there have to be kind of enough people who are willing to kind of pay, and then the insurance company can create sort of a pool here and assess their risks and charge accordingly. Okay, now the reality is different houses, different construction techniques, different locations relative to risks of fire. So in some places you got more risk of wildfires than others. Some places you got more risks of like tornadoes or things like that. So really, it's going to get a little bit more complicated to assess the true risk of losses and how big the losses would be. But this is the basic idea, all right? And hopefully this kind of gives you some context for that kind of that difference between avoidance versus minimization, but also the basic idea of how insurance works and what's kind of going on in terms of basically paying to have an insurance company take on that risk. Hopefully you enjoyed the video and hopefully you have a great day.